to discuss how you can navigate inflation in your portfolio. Let's bring in James Reagan, who is the D.A. Davidson Director of Wealth Management Research, here with us on the airwaves. Okay, let's dive into this. Where are some areas within the portfolio that are a little bit more exposed to inflation, and how investors can position themselves adequately?
Yeah, good morning. Good to be with you, Brad. Right off the top, I mean, we've seen with interest rates falling today, the bond market has rallied. So, just looking at bonds, that is something that I think investors are adding to portfolios today. We're seeing the bond prices rally, so that becomes something that investors should not forget about when they're building their portfolio allocations. Have an allocation to the fixed income markets. When we pivot over to the equity side, at least for today, we're seeing some of the more dividend sensitive, dividend paying sectors such as utilities and real estate investment trusts, the REITs, performing well. So we're seeing a little bit of a rotation out of the growth and maybe the technology or lower dividend payers into some of the sectors that pay higher dividends.
It's particularly interesting as we think about this dynamic that we've been watching play out, where equity investors are trying to kind of figure out where good news is or bad news is actually good news as it pertains to their equity portfolio. But at a certain point, doesn't bad news eventually have to become bad news? And what would you be looking for to really signal that the perhaps paradigm has shifted, if you will?
Yeah, I mean, it's a great point because, it's something that it can be a fine line, right? I mean, we've even seen it from Fed Chair Jerome Powell. I mean, yesterday at his testimony to the Senate Banking Committee, talking a lot more about the weakness in the labor market that they're seeing in the last couple of months, or at least in the most recent month, and that maybe that's something they're watching more closely than inflation right now. So as we're looking at this kind of soft landing scenario where economic growth slows, consumer spending slows, but stays positive, that's a pretty good environment, helps the inflation numbers, should allow companies to continue to report earnings growth. But if the consumer slows even more, and the economic growth slows even more, and we head more into a potential downturn, then that bad news does become bad news. So we're watching it closely. We're going to have to watch the labor market very closely, as Chair Powell has said, and we'll be watching a lot of the consumer data as it comes in over the summer.
It's interesting, as you were mentioning what we're expecting to hear from companies this earnings season as well. What do you believe the kind of prevailing theme or tenor around the macroeconomic read is that we could hear from some CEOs?
Yeah, I mean, the expectations for earnings are pretty good for the second quarter. A higher rate of growth, 8% or so, versus the 6% that we saw in Q1. So we are expecting companies to put up pretty good numbers. I will say that it's a lot of the earnings growth is coming from some of the tech-driven growth centric sectors. So I think they'll be kind of leading the way. So what we'd like to see is some of the companies below the radar that have, in sectors that have lagged this year, report good earnings as well. As we look at the second half of the year, expectations are that some of the technology earnings, the growth rates will slow. So we're going to need more broad participation in earnings growth across other sectors to kind of drive the overall earnings for the year. So as companies report, when we came out of the first quarter, a little less willing to give a full year forecast. But now with the year half over, we would expect companies to talk a lot more about what they see in the second half of the year. And I think companies it'd be more than just what the companies report. It's what the outlooks look for Q3 and Q4.
Yeah, really good point here. As we're thinking about what this first rate cut would mean to households and individuals, this morning we spoke to Mark Zandi, who's the Moody's Analytics chief economist, about how potential rate cuts might impact the consumers. I want to play here's what he had to say and get your reaction on the other side as well.
The most immediate benefit is to lower income households through lower payments on things like credit cards or consumer finance loans, buy now, pay later. Might see auto loan rates come in, and that would be very helpful for, again, lower middle income households who are been unable to purchase a car because of the cost of financing.
So maybe it's not an all-out kind of come off the sidelines, purchase that new home if you see the first cut come in, but maybe it is a little bit of relief is what he was getting at there on some of the rates that people are paying right now. I'd love your read through.
Yeah, I mean, I would agree with that. Relief is a good way of putting it. I mean, when you think about it, a 25 basis point interest rate cut is not, not a game changer necessarily by itself. So it's what it says more about is the Fed going to be able to continue to cut rates, and over time, if we look out into 2025, maybe we'll get several more of these cuts. So it does allow consumers, some relief if interest rates on credit products come down a bit. So it's not necessarily going to make them feel good initially about spending more, but it does create some relief on some of the credit that they've already accumulated. I think over time we'll need more rate cuts to support more confidence in spending.
James Reagan, who is the D.A. Davidson Director of Wealth Management Research. James, great to speak with you here today. Thanks so much for the time and insights.